Good afternoon, everybody, and thank you for joining us today. My name is Craig Breitsprecher. I am joined by Brian Winman from Fidelity Investments. And I've known Brian personally for about 10 years, and Fidelity has done a fantastic job in educating both clients and advisors on the importance of the current events that are shaping the markets without losing focus of some of the macroeconomics that really dictate where the market goes in a long period of time. So Brian will be taking care of the presentation and the way this meeting is set up. If you have questions after the fact, we can go ahead and get them answered via chat, and we will go ahead and get started. Thank you.
Hi, good afternoon, and thanks for the time. My name is Brian Winman. I've been with Fidelity for 20 years now. This is my 20th year at Fidelity. I grew up in Rhode Island, live here in Connecticut, and I've been in this role for 15 years and working with Craig for the better part of 10 years. And my role at Fidelity is I'm a conduit or liaison in between all of Fidelity's research globally and key partners and firms here in Connecticut. So kind of the context of being able to do a call like this is working with advisors that Fidelity is comfortable with and broker-dealers and firms that Fidelity is comfortable with. And in that capacity, we'll do some education. And then once a quarter, I'm meeting with Craig and his team, letting them know Fidelity's thoughts on the global markets, fixed income markets, et cetera. And that's part of what we do here as well. So I'm going to go through this presentation. We've been delivering a form of this for quite a while now. And what I hope you can see in front of you is a slide that says Investment Themes Q1 2019. And the tagline in green, which pretty much summarizes much of what's in here, is it's probably all about the trade. And speaking to that, we're speaking about having a trade deal done with China. And I'm going to tell you beforehand what we're going to talk about here so it's clear and you can have a clear roadmap of kind of where these slides are going. We basically think in order for this equity market to continue to run, we need to have a trade deal done with China. And if we get a trade deal done, this market will probably run longer than you expected. And if we do not get a trade deal done, we'll probably see recession quicker than you expected. But the likelihood, in our opinion, is that we probably get something done because both China and the US want something done. And what does getting something done mean? It could be as simple as a few paper changes that allow both sides to claim victory and the trade war simply ends, but we go back to where we were. Or it could be improvements on it from the US side, but both sides need to save face in this deal, but both sides' economies need to get this done. So that's effectively what we're going to talk about here today is that. And let me give you some context on what Fidelity's been saying dating back to 2013, because some of these slides are in here and some of them are not in this updated presentation. Fidelity has believed that we are in a secular bull market, and secular simply means long-term. Long-term in this case is a 12 to 15-year cycle. And if we were to show you a 100-year chart of the market here, you'll see the market tends to run in these 12 to 15-year cycles where 12 to 15 years we move sideways, and that's a secular bear. And if you can think about 2010, when you looked back at 2010 and said, my God, for the last decade, we've earned nothing. We had zero return. And the S&P return in 2010 was literally zero on the trailing 10-year number. That would be the definition of being in a secular bear. But in 2013, Fidelity believes we entered into a secular bull, driven by several things, driven by cheap energy and fracking, driven by a recovery in the housing market, and driven by recovery in jobs. And the question is, how long does this thing run for? So there's about a 3-second delay in the slides on my end, so I hope you can see these as I move. That has just changed to slide 2. But a couple of notes. Fidelity does believe that we're either right at the end of the mid part of the economic cycle or moving into the late part of the economic cycle. And if you look at the undulating wave that is the economic cycle, you kind of think about what happens here. You're in recession, and then you put a bunch of stimulus in the economy, and that's the early stage of the economic cycle where you get the initial growth after recession. At the midpoint of the economic cycle, that's the peak or the apex of the economic cycle, and at one point you roll over into late cycle, and that does not mean that you're in recession. It's simply an acknowledgement that growth has peaked and you're in a moderating growth phase, and that's where we believe we either are or are entering to right now. The late part of the economic cycle can last several years. It doesn't mean recession is forthcoming. It's just an acknowledgement that you've probably passed the peak of the growth cycle, and I'll show you some visuals on this in the corresponding slides. What is late cycle from a macro picture? Effectively, it means that we're seeing these characteristics. Characteristics 1, 2, and 3, or the blue, teal, and camouflage color green, have already happened. We've already seen labor markets tight, and we've seen wage pressure rise. That is the correction that we had last February, was based on the fact that wage inflation went from 2.6 to 2.9%. And so that was the market saying, oh my God, the economy's doing so well that they're going to have to wages are going up, and as a result, interest rates are going to go up. That was the first correction we saw last year. Part two, we've seen as well, the Fed hikes rates and yield curve flattens. And if you recall, in September and October, the reason for the stress in the market was the Fed saying the economy is doing so good, not only are we going to raise rates, we're going to raise them more than we might need to. So we've already seen that part, and the credit cycle tightening as well. The fourth phase of this, profit margins compressing, earnings growth decelerating, we have not seen that yet, but we will likely see that some point in either 2019 or early 2020. Again, that doesn't mean that profit margins won't be strong or earnings growth won't be positive. It's just an acknowledgement it will be a little bit off the peak. And this is the least consistent cycle phase in terms of duration and character. It's tough to predict how long it will last, and it's tougher to predict which asset classes will do well. But in general, stocks and bonds still outperform cash. And as you'll see on one of the next slides, not the one I'm showing you right now, but the one after that, it's a time when commodities do well. So some of the things, what it means in terms of asset markets, your asset allocation, in our opinion, should be pretty close to neutral. And when we say neutral, that's going to be different for every single person on the call. And Craig is obviously giving you assistance on this, but it just means you wouldn't want to have a massive overweight to equities, or a massive overweight to bonds, or a massive overweight to risk, or a massive overweight to defense. It's effectively whatever your traditional rate is, your allocation issue should be pretty close to it. We still think the tilt should be slightly overweight to equities. But again, when we say where we are in terms of your asset markets, so there's elevated uncertainty, there's higher market volatility, the return profile is historically less positive than mid-cycle, but again, still positive, still not recession. And that's what it means from an asset allocation perspective. And the slide you will see coming up here, the title of it is Late Cycle, Less Favorable Risk Return Profile, but still potentially positive. And you can see how this differs from mid-cycle. The consistency of stocks outperforming in mid-cycle and high yield outperforming in mid-cycle is much greater than that of late cycle. I mentioned late cycle is a precursor to recession, not that recession is immediate, but it's the cycle before recession. And one of the things that is very consistent with recession is that we have inflation. As such, that's why you see commodities performing better here in late cycle. That is the yellow bar. Things like energy, real estate, other types of physical and raw commodities, the two things that tend to happen before we see recession, we have inflation. And the other thing is, sometimes you will get an overhang of inventory that forces companies to lay people off, and that slows the economy down. Think about even 2008, effectively we had an overhang in the housing market as part of a function of that. So again, this is certainly not recession, and it's all tied to trade. It really is. And that's the view. And we can almost end this presentation with the first soundbite of, if we got trade, this is going to run longer than you thought. If we don't get trade, we're going to see recession quicker than you think. But we do feel with pretty high conviction that it's likely that we will see a trade deal done, again, because China needs this as much as we do. So the question with all this comes on the next slide, and this is the question most investors has: how long does the growth phase of the economy last until the next recession? And to the point we made earlier, it probably all depends on how the trade uncertainties unfold. So we'll show you a couple different scenarios here. The first would be a full-blown trade war. And the reason that this is a problem, just start from the top left-hand corner. We have the 2018 tariffs that are already in place. The 2019 tariffs that would apply to China only. And as you can see, there's around 2, around 3, and around 2, around 3, and around 4. There's a typo in there, I apologize. And then, is there any potential retaliation and expansion beyond China? This is all on the top of this page in gray. And then you see the arrow pointing down, what that corresponds to. The tariffs increase inflation, which we mentioned, inflation is a precursor to recession. That leads to higher interest rates. That leads to uncertainty increasing. That leads to less investments. That leads to less hiring. And you've heard many CEOs talk about the fact that they can't make business plans without knowing what is happening with tariffs. And again, realize what rising interest rates do and why everyone's afraid of them. It just takes certain consumers out of the markets for certain products. If you continually raise rates, fewer consumers can afford certain cars, certain homes become out of price for certain consumers. You're much more likely to put the money in the bank and less likely to refinance or do a project in the home. And all those, by design, have a negative effect on the economy, slowing it down. Again, this scenario one is not one that we feel is a high probability event. It's certainly not zero, but we think it's a lower probability event than scenario two, which is that, well, we'll show you scenario two in a second, but how likely is it? One of the things that, I'm not sure if you've heard this before, but presidents have typically enacted pro-growth policies in the third year of a presidential cycle, and this is often in an effort to get reelected, and you have to go back to 1950 to see a year three of a presidential election cycle. So this is year three for the current administration. If you went back to President Obama's year three, they agreed to extend what the Democrats had labeled Bush tax cuts for the rich in order to get bipartisan cooperation on other deals that they wanted to get done to get economic expansion. So if we were to see a negative year three, it would be the first one since 1950. Is that impossible? No, but it just points out that we are in a sweet spot of two separate cycles. There's the cycle of the presidential election cycle. Also, months November to May of any calendar year tend to be the better parts of the economic year. So there is some tailwinds in terms of where we are in cycles right now. And you see in the blueprint in the middle of the slide, on average, the S&P has been up 15% in the 12 months following midterm elections. So scenario two, which is page 9 of this presentation, with a permanent trade truce, the business cycle could elongate as consumers in a very strong position to spend. And with all of the noise, and I've been in this role for 20 years, and I've always tried to avoid politics, but you have no choice in the last 3 years but to be informed how politics affect the market. I would ask that you realize that any comments on politics, and we've made some already, are strictly in relation to the market. Remember, your money is green, it's not red or blue. But when you look at the strength of the economy is doing very, very well. And from the top left-hand corner, unemployment is at a historic low. Moving to the right, the consumer will likely benefit from lower oil prices and lower gas prices. And you think about this, no one is complaining when it costs less to fuel their home or heat their home in the winter. No one's complaining, and people are spending that money when it's cheaper to put gas in the car. And on the bottom right-hand side of this page especially, it's not as if we hadn't been saving and need to save from a historical perspective. Our savings rate is running at a very good clip. So the consumer is coiled and ready to spend. And also we mentioned, going back to that top right-hand corner, inflation is typically a precursor to recession. And something that's been very, very deflationary has been oil prices. Oil prices being down is good, and cheap oil in general is good for the economy, right? It's bad for the 8 states that are oil producing entities like a Texas, but in general, cheap oil is good. It's great for 42 states and so for the 8 that are energy producing. But a permanent trade truce, the one challenge here and the one wild card is, and we always hear about the U.S. side of the story and the leverage the U.S. have. The one side where China has leverage is from a political standpoint, and it's the difference in dealing with a democracy versus a dictatorship. In a democracy, if you're a dissident, your voice is heard, you get on TV, you get in the news, you speak with your representatives, and your representatives represent you, and then there's a possibility that there's a change of leadership. In a dictatorship, if you're a dissident, you go missing. And I say that somewhat tongue-in-cheek, but your voice is simply not heard. And that is one thing that China has in its favor. They could simply try to hold out, but their economy is doing very, very poorly as well. Their economy is doing much worse than ours. And we say a trade truce. Again, there may be no material changes here. It may be just enough tweaks for both sides to save face. And China's GDP number has been revised down. And now that we've actually seen a negative revision to that number, it may be easier for them to make a deal because they can come back to their people and say, hey, it's not as if we went from 12% GDP and did a deal and we're at 11. They can say, hey, we're down at 6 or 7. We made a deal. Now we're back to 10. And they can save face in saying that the deal was a good deal for them as well as for everyone else. One thing that I'm sure if you've watched your portfolios or watched the markets that you've been aware of is the pain that we've seen in the international markets. And the point of this visual on page 10 is a trade resolution could be very beneficial to the rest of the world. What this chart is showing you is the percentage of GDP or a country's growth that comes from exports. And you can see in the US, it's roughly 7 to 10% of our GDP comes from exports. Again, we're a consumer-based economy. 70% of our GDP comes from the consumers, and no one consumes products quite like Americans do. But when you look at Europe as an example, close to 40% of their GDP comes from exports. The rest of the globe really needs this deal done a lot more than the US does. And in theory, this should really help international markets as well. So as well as this would extend the US equity rally, it would breathe life back into international equities as well. And one of the factors or one of the things that have happened as a result of these recent corrections is and this is the next slide as well. I think it's a very powerful slide after this one, but I want to show you this one to set it up first, is that we've really seen a reset in terms of the PE ratios of not only US, but emerging markets and developed markets. And those are the acronyms there on the left-hand edge of this chart. EM is emerging markets. The blue obviously is US, and DM is developed markets or international, non-US, not emerging is what that stands for. And so you see the PE for the US now at 14%. In February of this year, that was at 22%. The US markets felt a little bit expensive, and we're down to an area that's actually cheap right now. Emerging markets, very cheap at a 10.5% PE ratio. And we really do like the emerging market story. And if you're a long-term investor, that is the cheapest area, and there's better growth prospects than in the US over the next 20 years. Fidelity forecasts US GDP over a 20 or 25-year number to be roughly around 2%. Over the emerging markets will be much higher, but we simply can't tell you what's going to happen in the next 6 months if today's the right entry point. But if you're a long-term investor, systematically investing in that area makes a lot of sense to us. And then developed markets at 12% PE. They've also, especially the developed markets, have also been hurt pretty badly by a rising dollar. And there's a lot of data from Fidelity that says that should be ending, and if anything, the dollar should be weakening going forward, but certainly not strengthening. And I think one of the most powerful slides, and it's the piece we speak to most right now, is this slide on page 12, which says 1985 and 1995 could very well be the right analog for 2019. And it feels to us like 2018 very much resembled 1984 and 1994. And I hope this translates on your end as I zoom in, but I'm going to zoom in on the content around 1994. And if you look at the red text, assuming that this has zoomed on your screen the way it is in mine, and even if you can't see it, I'll read it to you. In the top left-hand corner of the 1994 rectangle, it talks about what happened to the S&P. It traded within a 10% range. The real GDP year over year was up 4%. Corporate earnings were up 19%. But yet on the year, PE ratios dropped 3 points. But the following year in 1995, the S&P was up 35%. So 1994 also saw rising rates. It also saw cash do better than bonds and equities. But it ended up serving as a reset year within a broader bull market in 95 as well as 96, 97, 98. And we're not saying there's a 5-year run after this, but it has a very similar feel with a 10% correction and a 7% correction to this year. And again, hoping that you can see this visual, but if not, I'm going to read you the data. When I scroll in to show you 1984, the S&P traded within a range, again, top left-hand corner of 13%. GDP was up 7.3% year over year. Corporate earnings were up 21%, yet PEs fell by 2 points, and we had corrections of 10% and 9%. And again, 84 served as a reset year. So coming into this year, Fidelity has said we need 3 things to happen in order for these equity markets to resume running. One of them is we needed the Fed to soften their language on how aggressively they were going to tighten rates. We have gotten that. The second one, as we have mentioned here, is trade. And the third was we needed a capitulation type event in terms of sentiment and in terms of selling of stock, which we got in December. Which we got in December. We had the S&P was down 16%, which we got in December. The S&P was down 16% as of Christmas Eve, and we saw massive redemptions or selling of equities across the industry. and I can tell you at Fidelity, we saw a lot of money going into cash as well, as people who had rode out all these bumps in the market all year finally said uncle in December, and fear hit high levels. And that was something needed to happen. We needed to see mass selling in order for this to continue. And that's also what drove down PE. So this goes back to the fact it's all about trade. But I'm on slide 13 here. And again, I hope that's reflecting on your end. In the long term, we still are in a secular bull market that started in 2013. And we often get the question, why 2013 and not 2009? 2013 represented the point where we passed the previous cycle high in 2007. And that's the reason this is a 2013 phenomenon, and not a 2009 phenomenon, as we sometimes get the question. And history does not always repeat itself, but it often rhymes. And these are the last two secular bull markets that we have seen in the 50s and the 80s. And I hope you can see this on your end. The gray bar represents the 50s. The green bar represents the 80s, and the blue bar represents where we are now. And there will be a significant correction somewhere in the middle of this secular bull market run, which will likely correspond with recession. And the way our firm has talked about this is, for context, if you think about what historical norms are, you normally get 3-5% corrections a year. You normally get 1-10% correction a year, and a 20% correction every 2 to 3 years. And that 20% correction normally corresponds with recession. So if you're down 10 or 12%, but you think we have a pending recession coming, then yeah, it's time to play a little bit more defense. We simply don't see that happening yet, provided that trade gets done. So Fidelity does, in this environment, recommend that you take a barbell approach to your portfolio. We do believe you should have, again, close to whatever neutral is for you, right? If 50-50 bond equity is neutral, we think you can tilt a little bit into equities, but should be pretty close to that neutral mix. And just be mindful of the fact that wherever you're playing defense in the portfolio, make sure that fixed income is actual fixed income, right? Interest rate sensitive fixed income, that when interest rates go up, you will lose money in that fixed income, and that's okay, because typically when that happens, your equities are making money. And that's kind of the definition of a barbell. And I won't spend a lot of time in this next slide on page 16, but there's a lot of talk in the industry about active versus passive. And all this slide on page 16 shows you it's one slide from a larger presentation we have. There are certainly places where it makes sense to be passive, but there are lots of places where active makes sense. And this is simply showing you the green dots above the blue dots are showing you places where active has been a stronger story than passive. And you can see there's kind of one out there, large cap growth, where more passive funds have done better. But in general, there's a compelling argument to have both passive and active in your portfolios. I'm going to skip the propaganda slide of Fidelity funds, and I want to show you a few of the slides in the appendix here. Slide 20, which you should be seeing coming up any second, shows U.S. equities versus global equities. And you can see that there's a part in this presentation on the slide in the far right-hand side that is circled, and that shows the divergence of returns between the U.S. and the rest of the globe. So the blue line is the S&P, the green line is the MSCI World Index, or said another way, everything but the U.S. And these normally move in lockstep. There tend to be these 6 or 7 year periods of outperformance by one, and then mean reversion. And we simply have not seen that mean reversion happen. Mean reversion is a very powerful thing. We do think we see this, and this is another compelling reason to be looking at international equities here, as well as U.S. equities. And I also think of it from a perspective of many of the clients that we call on. If Craig or an equivalent peer of his is doing a review for a client at the end of the year and they're unhappy with risk or they're unhappy with returns, often the thing that gets thrown out first is what you're least familiar with, and that's international equity and emerging equities. Fidelity does believe that 30% of your equities should be international and emerging. So to be clear, if you were someone who has 60% in equities and 40% in bonds, it would be 30% of that 60, which would equate to 18%. So I also think it's important to note that Craig may not think that's right for you, and that's fine too. We're just giving you, and other firms that Craig deals with may give them different perspective. This is simply Fidelity's view here. And this next chart that I'll show you is one of the last two. I don't want to spend too much time on this because it's a little bit difficult explaining this chart, but basically what it's giving you evidence of is the fact that Fidelity thinks we likely see dollar weakening going forward, and that when the dollar weakens, that's a tailwind for international equity. Last year, the dollar really strengthened, and that contributed several percentage points to international doing poorly. And lastly, just a couple of slides on fixed income. The reason you own bonds is typically when equities perform poorly, bonds do well. There's only been 2 years really where bonds and equities have been down. And last year, the proxy for bonds, the Barclay Ag, was flat, and equities were down 4. But it was 1931 and 1969, in which those are the only 2 years in which we've seen both bonds and equities fall. But what you see in this chart is bonds are green and equities are blue. Typically, when your equities do poorly, the result of that is the 10-year Treasury drops and your bonds do well. And again, this is the reason you own these things. It stabilizes a portfolio. In the last slide I'll show you today, on page 23, everyone's worried about how much it can cost to have the insurance of a bond fund, and they're worried about how much their bonds can go down if rates can go up. And the point of this slide is to provide some perspective. To have a bad year in bonds, that's a bad 12 minutes in stocks. It's a bad 60 seconds in Bitcoin. Awful year in bonds is down 2%. And if you look at this chart, and again, this is using the equivalent of the Barclay Ag, there are 4 periods when we've been down 2% on the year, 56, 69, 94, and 2013. Last year, we were flat on the bond market. The Barclay Ag was even, but everyone's worried about what if rates go up, how badly can it affect the bond fund? And the average return, as you can see, I hope you can see this, it's the first line under how much does that insurance cost historically. The average return over this period from 1940 to currently is 5.6%. And everyone kind of will say, well, you're cherry picking that point when interest rates went down. If you just took 1940 to 1980, a period in which rates were rising, you still had a 3.5% return in the Barclay Ag over that period. So just in summary, and I hope this was time well spent for everyone, it really goes back to trade. If we get trade done, which we think we do, this equity market runs longer than we would have thought. If we don't get trade done, we're more likely to see a recession. But in Fidelity's view, the 3 things we needed to happen, one of them is a trade deal, which we believe is likely to happen or more likely than not to happen. The other 2, we've already had a panic sell in December and the Fed softening their language. We do think we have room to run here on the equity side. So let me stop there and take a breath.